What is up, guys? Welcome back to another video. So today we're going to get right into it. We're going to be talking about a small account trading plan. Basically, I'll be showing you how I took $3,000 to $27,000 on my small account, and also I'm just going to be breaking down the exact strategy that worked for me. Now, I'm not saying this is going to work for you. However, this is what worked for me, and I hope you can pick something up from this video. My strategy is formed off supply and demand. Now, this will be the only strategy needed to compound your small account over time. No indicators, no extra fluff. Just pure price action is all you need. And in my opinion, if you were just a beginner starting, this is exactly where you would want to start. Forget the indicators and forget everything else people talk about. This is really what you want to focus on. Trading a small account with options, you want to be focusing on large cap names. So SPY, QQQ, Apple, Amazon, AMD are my top 5 names, and they all have relatively cheap options. So I think for a small account, these 5 stocks are perfect. In this strategy, less trades actually equals more money. See, the common mistake new traders make is overtrading. Overtrading will never be good, and also you have to factor in the PDT rule. If you're under $25,000 and you don't have a cash account and you have a margin account, you can only take 3 day trades a week. So you have to factor that in. However, if you have a cash account, you shouldn't be trading every single day. If you could find the best setups every week, you'll be way better off and way more profitable. The reason why we'll be trading less is because we'll be finding higher time frame supply and demand zones, which will help us trade less, execute less, but ultimately profit more. Choosing the right option contract. So when I find supply and demand zones using the daily, the 4-hour, or the 1-hour time frame, I trade weekly contracts that are 1 to 3 spots out of the money. While these may be more expensive than 0 DTEs, they are safer, limit risk, move less, and give you the ability to have patience to wait for the move to actually happen. You can choose to trade 0-day expirations. In my opinion, it's just not worth it. Now, say if you found the zone on a 15-minute time frame or a 30-minute time frame, then the expected move is a little less than a higher time frame zone. So therefore, you can play it as a scalp scenario and take a 0 DTE expiration contract and make it work for you. This is the part where you have to find what works for you. Personally, I want to go the safer route and look for the bigger move. So I look for the weekly contracts and go 1 to 3 spots out of the money. Position sizing is really important on a small account. So before entering, I calculate the risk to reward ratio. A higher time frame zone usually presents a 1 to 2, 1 to 3, 1 to 4, 1 to 5, etc. risk to reward. So which is perfect in our scenario. We could take 1 trade a week, but if we can execute on a trade that's a 1 to 5 risk to reward, that's way better than taking scalps all day that are maybe 1 to 1 risk to reward. As a new trader or an inexperienced trader, traders fail to execute because they take profits too early, making the RR lopsided. Maybe it's 2 to 1, maybe it's 3 to 1, 4 to 1, etc. Or they let their losers run, making it a failed risk to reward. Depending on your account size will determine the amount you put into a trade. One way I found of picking a position size is factoring in the potential loss of a setup. If I'm okay with risking that amount, then I can take that trade with that amount. It's important to note that I am experienced. I've been trading for years. So I want to clarify that general rule of thumb is 2% of your account to risk in a trade. However, this really won't work if you're using a small account because of the small amount of capital you have. If you could put a number in your head that you're willing to risk comfortably without using emotions, that's the number I would use. When you factor your risk to reward, it will all make sense and just give you a solid game plan to execute the trade. So now I'm going to show you a real example from this week. Trades like this don't come every day, and they may not come every week. However, this one trade could profit you more than if you were to take multiple trades. Therefore, high time frame zones, in my opinion, present the highest probability. Okay, here we have the SPY chart, and as you can see, I already went down basically step by step and broke down this trade. However, I'm going to show you exactly how I found it and exactly what I did in able to actually be able to execute this trade. So first, we have to go to the higher time frames. First, I start on the daily, and I identify zones, right? I go look for significant points. However, the market has been extremely choppy, and it's very hard to identify exact zones. So now let's dial in a little bit closer. Let's go to the 4-hour. So when looking for supply or demand zones on any time frame, you're looking for significant moves where buyers or sellers have pushed the price. We can see we've seen a significant move off this level. Now, what is this level telling me? Well, as the price hit this level, buy orders were filled and pushed the price up, and potentially leaving big buy orders sitting here unfilled. So I draw the zone from the body low of this candle to the top body of this candle, and then I end up drawing it all the way across to current price action. Now, when I execute any zone, I'm looking at the 5 and 15-minute time frame to execute these zones in real time. So as we can see, that morning, SPY was trending down. Coming close to our demand zone, we finally touch our demand zone. And what happens? Buy orders are filled, and as we can see, price is pushed up. Now, how do we execute this? Well, we take our position as we enter this zone. Now, the only thing I'm worried about is my potential risk, because I already know my setup is there and my potential is there, but I'm worried about my risk in this trade. Say if this trade didn't go to the upside and actually this candle was flipped and was a red candle and closed below this zone I have, I would just simply stop out. Now, this is so significant because my risk was so limited to my potential reward. This is the power of using higher time frame zones. As you can see, our potential 1 to 2 risk to reward was up here at this 377, and potentially our 1 to 5 risk to reward was up at this 380. So obviously this was a huge winning trade and a perfect example of how you should trade a higher time frame zone. With a candle close out of the zone, simply we are stopped out. A 1 to 5 risk to reward trade is amazing. This is why I say one trade a week is all it really takes. Okay, now when it comes down to the contract, today is Friday. This example was from earlier in the week, so it might be a little different, but it's the same concept. So if I wanted to trade SPY today, I would not go to the same day expiration Friday. I would actually go to next week's expiration and pick, say if I wanted to play puts, pick 1 to 2 to 3 spots out of the money. That's just what's worked for me and my strategy. Now that we know exactly how to execute this trade, how to factor in our risk to reward, all it comes down to is your actual position size. So what I want you guys to do for me is type out in the comment section below what your account size is. Give me a range. Maybe it's $1,000 to $5,000. Maybe it's $5,000 to $10,000. Give me a range of your account size. Now, the most liked or commented on account range, I will actually make another video explaining how I would trade that certain account. So if you guys enjoyed this video, make sure to subscribe, like, and comment down below. I told you in 2023, it's my mission to provide you as much value as possible. So thank you guys for watching, and until next time, peace.